During the COVID crash of 2020, while 89% of retail investors were panic selling at massive losses, a small group of everyday people made life-changing money. Imagine turning $10,000 into over $100,000 in just 18 months. Sounds impossible, right? But it happened. These weren't Wall Street elites. They were teachers, nurses, and office workers who recognized one critical principle about market crashes. It's a principle that separates those who panic from those who profit, and I'm about to share it with you. Stick around, because understanding this could completely change how you see opportunities in the market. The psychological trap of panic selling. When markets crash, 90% of investors lose money. But here's the surprising truth. The market itself isn't to blame for these losses. It's your brain working against you. Our brains haven't evolved much since the days we were running from saber-toothed tigers. That same panic response kicks in when we see our portfolio dropping, triggering a cascade of stress and fear. Scientists have studied this phenomenon and found that during market drops, traders' cortisol levels, the body's primary stress hormone, spike by 37%. This surge activates the fight-or-flight response, a survival mechanism designed for physical danger, not financial decision-making. Your body prepares to flee or fight, not to calmly evaluate your investments. This is why so many people sell at the worst possible moments. Take 2008 as an example. During the financial crisis, investors pulled $2 trillion out of the market at its lowest point. They locked in massive losses just before the recovery began. The S&P 500 dropped 57% from peak to trough, but those who stayed invested saw their portfolios fully recover within 4 years. The ones who panicked and sold never regained that money. Think of your brain during a crash like a faulty fire alarm. The amygdala, the part of your brain responsible for processing fear, takes over and screams danger, even when there's no immediate threat to your survival. This hijacks your prefrontal cortex, the area responsible for logic and planning, and shuts down rational thinking. Instead of focusing on long-term goals, you become consumed with stopping the pain in the moment. Professional traders understand this biological trap. They've trained themselves to recognize the physical symptoms of panic, a racing heart, sweaty palms, that sinking feeling in the gut. When they notice these signs, they pause and resist the urge to act impulsively. Amateurs, on the other hand, often let these feelings dictate their decisions, leading to costly mistakes. The market doesn't care about your emotions. It will continue to rise and fall regardless of whether you're calm or panicking. But here's the good news. Understanding this biological response gives you a powerful edge. When you feel that overwhelming urge to sell everything, you can remind yourself that it's just your ancient survival instincts misfiring. By pausing and thinking critically, you can avoid making decisions you'll regret later. So, the next time the market takes a nosedive, remember this. Your brain might be shouting at you to run, but that alarm isn't always accurate. Recognizing the difference between a real threat and a false alarm could be the key to staying on track and achieving your financial goals. Historical patterns you can bank on. Market crashes might seem random, but they follow the same emotional playbook every time. From 1929 to 2020, every major downturn has moved through identical stages of panic and recovery. The players change, but the game stays the same. First comes the shock phase, prices drop fast, and everyone freaks out. Then denial sets in as people convince themselves it's just a temporary blip. When the decline continues, fear takes over. That's when most investors make their biggest mistake, selling at the bottom. Finally, recovery begins, but many miss out because they're too scared to re-enter the market. The data shows this pattern clearly. Over a 20-year period ending in 2024, the market traded more than 10% below its peak on 34% of days, and more than 20% down on 16% of days. These dips happen regularly, yet most investors treat each one like it's the end of the world. Think of market movements like a roller coaster. The drops feel sudden and terrifying, but they're part of the ride. Recovery times vary wildly. The 2020 COVID crash took just 5 months to recover, while the 1929 crash took 25 years. But here's what stays consistent. The average investor misses the first 40% of every recovery. They wait for proof the danger has passed, but by then, the biggest gains are already gone. Let's look at some examples. After the 2008 crash, The S&P 500 gained 65% in the first year of recovery, but most people didn't participate in those gains. They sat on the sidelines, waiting for confirmation that the worst was over. Similarly, in March 2020, fear peaked as the market dropped 34%. But just 5 months later, it had fully recovered. Those who sold in March locked in losses, while those who bought during the panic made huge gains. Bear markets typically last less than a year, while bull markets run for years. Yet people act like every downturn will last forever. Over a 20-year period, the market spends about 35% of days trading more than 10% below its peak. These pullbacks are normal, not apocalyptic. The emotional cycle creates predictable opportunities. When everyone else is panicking, that's when you want to be buying. When they're cautiously optimistic, that's when you want to be holding. When they're euphoric, that's when you want to be selling. You don't need to predict exact bottoms to profit. You just need to recognize when we're in the fear stage of the cycle. That's when quality assets go on sale. Over a 20-year period, the market gives you these opportunities on about 1 out of every 3 days. The key is understanding that crashes aren't anomalies. They're features of how markets work. Prices don't go up in a straight line. They take stairs up and elevators down. The drops feel scarier than the climbs, but both are necessary parts of the process. Most investors focus only on the elevator rides down. They forget that every previous crash eventually led to new highs. Even the Great Depression didn't permanently destroy the market. It just created a longer recovery period. Since 1926, the S&P 500 has experienced a decline of 20% or more about once every 6 years on average. These events are common, not rare. Yet people treat each one like it's unprecedented. Investors who stay the course or add money during downturns consistently come out ahead. The contrarian playbook: 3 rules that create wealth. Warren Buffett didn't make $10 billion during the 2008 crisis by accident. He followed 3 simple rules that any investor can use. Most people break all 3 within the first week of a market drop. That's why most investors lose money during crashes, while a few make fortunes. Contrarian investing is like swimming against the current. It's about moving in the opposite direction of the crowd, seeing opportunities where others see only danger. Rule 1 focuses on mindset. Be greedy when others are fearful. In October 2008, when markets were collapsing, Buffett wrote his famous New York Times op-ed, declaring he was buying American stocks. While others were selling in panic, he was putting billions to work. For example, his $5 billion investment in Goldman Sachs preferred shares paid a 10% dividend, $500 million annually in interest. Goldman later bought back those shares at a premium, further boosting his returns. Buffett didn't try to time the absolute bottom. He acted when prices made sense and fear was at its peak, reversing the natural tendency most investors have to panic sell during downturns. Most investors do the opposite. They get greedy at market tops when everyone's making money, then turn fearful at market bottoms when everything's on sale. Buffett's approach works because he looks for quality companies that can survive the storm and buys when their stocks are unfairly punished. In 2008, he applied this strategy to companies like General Electric, Swiss Re, and Dow Chemical, securing favorable terms that compensated for the risks. Each deal followed the same principle. Invest in strong businesses facing temporary problems. Rule 2 builds on preparation. Have cash ready before the storm hits. Buffett always keeps billions in cash as ammunition for opportunities. In 2008, that cash allowed him to act decisively without selling stocks at low prices to raise funds. Most investors, by contrast, keep too little cash in good times and are forced to sell holdings during crashes, often locking in losses. The Goldman Sachs deal highlights why cash reserves matter. During the crisis, even strong firms needed capital. Buffett's $5 billion investment came with warrants to buy more Goldman stock at $115 per share. By 2011, Goldman stock traded above $150, making those warrants extremely valuable. Without cash reserves, Buffett couldn't have made such a lucrative move. Cash isn't just a safety net. It's what lets you seize opportunities when others can't. Rule 3 emphasizes discipline. Stick to your plan no matter what. Buffett decides his investment criteria in advance and doesn't abandon them when markets get volatile. His principles, buy undervalued companies with strong fundamentals, guided his 2008 moves. For instance, his $3 billion investment in GE preferred shares came with a 10% dividend and a premium if GE repurchased them within 3 years. GE did just that in 2011, earning Buffett both the dividend and the premium while helping stabilize the company during the crisis. These rules sound simple, but are hard to follow. Human nature pushes us toward herd behavior. When markets crash, the instinct is to retreat to safety. Buffett's approach works because it bets against this instinct. His 2008 deals shared key traits. They involved strong companies facing temporary problems, offered favorable terms, and were made when others were too scared to act. Contrarian investing requires patience. After Buffett's New York Times piece, markets kept falling for months. His investments lost paper value before ultimately paying off. Many investors can't stomach this short-term pain, but crises create opportunities precisely because they test resolve. The bigger the crisis, the bigger the rewards for those who stay disciplined. Buffett's approach doesn't require billions to work. The same principles apply at any scale. Keeping cash reserves lets you act when others can't. Buying quality assets when their distress pays off over time. Sticking to predefined criteria prevents emotional mistakes. Most investors learn these lessons too late, after they've locked in losses by panicking. The smart ones prepare in advance, so they're ready when chaos strikes. Beginner's Blueprint: simple steps for first-time crash investors. New investors actually have an edge during market crashes, but only if they avoid the common traps. While experience helps, beginners can profit by focusing on simple, proven strategies instead of trying to replicate complex Wall Street plays. Analysis shows that beginners who attempt advanced tactics make 23% more mistakes during market turmoil. The key is sticking to fundamentals, rather than getting fancy. Here's your 5-point checklist for navigating your first market crash successfully. 1. Start with dollar cost averaging. This strategy involves investing the same amount at regular intervals, regardless of market conditions. For example, during the COVID crash, an investor contributing $500 monthly to an index fund would have purchased more shares as prices dropped, lowering their average cost per share. When the market rebounded, those shares gained value, resulting in higher returns compared to those who stopped investing. Dollar cost averaging removes emotion and builds your position steadily. 2. Focus on dividend-paying stocks from stable sectors. Companies that maintain dividends during downturns often have strong balance sheets and reliable cash flows. Look for dividend aristocrats, companies with 25-plus years of consistent dividend increases. These businesses tend to weather downturns better than speculative growth stocks. Sectors like utilities, consumer staples, and healthcare are particularly resilient, often maintaining dividends even when other industries cut them. 3. Keep your portfolio simple. Avoid exotic investments like options or leveraged ETFs, which can amplify losses during volatile markets. Stick to individual stocks or broad index funds that you understand. A good rule of thumb: if you can't explain an investment to a friend in one sentence, it's probably too complex for your first crash. Simplicity reduces the risk of costly mistakes. 4. Set strict stop-loss rules in advance. Decide how much loss you're willing to tolerate on each position before the crash happens. For instance, you might set a stop-loss at 7 to 8% below your purchase price. Write these numbers down and stick to them. This approach prevents emotional decision-making during market volatility and preserves capital for better opportunities. 5. Maintain a cash reserve. Keep 5 to 10% of your portfolio in cash, even during bull markets. This reserve allows you to buy quality assets at discounted prices during a crash without selling other positions at a loss. Many beginners invest every available dollar during good times, leaving them unprepared when bargains emerge. Beginners often outperform during crashes when they follow these basics. Without the baggage of past mistakes or overconfidence, they're more likely to approach opportunities with fresh eyes. However, this advantage disappears when they try to mimic sophisticated investors too soon. Behavioral studies show that emotions like fear and greed can derail beginners during volatility. Automating decisions, such as setting recurring investments, stop-loss triggers, and predetermined buying lists, helps prevent emotional mistakes. Create your plan when markets are calm, and stick to it when chaos hits. One common mistake is trying to time the exact bottom. Even professionals rarely get this right. Instead, focus on buying quality assets at reasonable prices. For example, if a stock is 30% cheaper than its recent high and has strong fundamentals, it's likely a good buy, even if the market drops further. Dividend reinvestment is another powerful tool. During crashes, reinvested dividends buy more shares at lower prices, boosting your position before the recovery. Many brokerages offer automatic dividend reinvestment, making this process seamless. Finally, avoid information overload. During crashes, financial media floods the airwaves with opinions and predictions, most of which are noise. Stick to concrete data like company financials and economic indicators. The simpler your information sources, the better your decisions will be. Advanced tactics, leveraging volatility like a pro. Volatility is where experienced investors make their real money. When markets drop 10%, most people see danger. Seasoned traders see opportunity to make 50% or more. The difference comes down to 3 professional-grade tactics that turn market chaos into profits. Volatility-based position sizing lets you maximize returns while controlling risk. This technique adjusts your position sizes based on how much an asset typically moves. For example, imagine you're managing a $100,000 portfolio. A stock that swings 3% daily might get a $5,000 allocation, while a stock that moves 10% daily might only get $1,000. During the 2020 crash, traders using this method avoided overexposure to the most volatile sectors. They could stay in the game while others got wiped out. By matching your position size to an asset's historical price movements, you automatically control risk and can profit from volatility without taking unacceptable losses. The Kelly criterion takes this a step further with mathematical precision. Think of it like betting on a well-calculated coin toss. This formula calculates exactly how much to bet based on your edge. The equation looks like this. Optimal fraction to invest, F equals BPQ/B. In simpler terms, B is your potential profit compared to potential loss. P is your estimated chance of winning, and Q is your chance of losing 1P. For instance, if you find a trade with 2:1 payoff potential and a 60% win rate, the Kelly formula suggests investing 20% of your capital. During the 2008 crisis, traders using this method sized positions perfectly for extreme conditions, making bigger bets only when the odds heavily favored them. The math prevents overbetting during uncertain times. Hedging with put options acts like insurance for your portfolio. When markets crash, puts increase in value as stock prices fall. Buying puts gives you the right to sell stocks at a set price before a certain date. If prices drop below that level, your puts gain value, offsetting losses in your other positions. Hedge fund manager John Paulson famously used this strategy in 2007 to 2008, earning $20 billion as the housing market collapsed. The key is buying puts on stocks you own or sectors you're exposed to, creating a floor under your potential losses. When the 2020 crash hit, traders with proper hedges could ride out the storm. Their puts gained value as their stocks dropped, balancing the damage. Advanced traders also watch for sector rotations during crashes. Certain industries get hit harder than others. The worst performers during the downturn often become the best rebound plays. After 2008, financial stocks like Bank of America and Citigroup were left for dead. Paulson pivoted in 2009, buying billions in bank stocks just as they bottomed. This contrarian move capitalized on the coming recovery. The same pattern played out in 2020 with travel stocks. Savvy investors bought airlines and hotels at their lows, then rode the rebound. Another pro move involves volatility arbitrage. This means taking advantage of price differences between related securities. During panics, these relationships often break down temporarily. Options might become mispriced relative to the underlying stocks. ETFs might trade at premiums or discounts to their net asset values. In March 2020, some bond ETFs traded 10% below their actual holdings. Professionals stepped in to buy the ETFs while shorting the underlying bonds. As prices normalized, they pocketed the difference. This strategy requires precise timing and deep market knowledge. Leverage is the final piece of the puzzle. Used carefully, it can amplify returns during market extremes. The trick is applying leverage only to your highest conviction, best hedged positions. During the COVID crash, some traders used 2:1 leverage on carefully selected tech stocks. They combined this with protective puts to limit downside. When the rebound came, Their gains doubled while their risk remained controlled. This selective leverage separates the amateurs from the pros. These three tactics, volatility sizing, the Kelly criterion, and hedging, work best when combined. Together, they form a complete system for profiting from downturns. Most traders fail because they use these tools incorrectly or not. The cash conundrum. How much to hold for crash opportunities? Cash is your secret weapon when markets crash, but most investors get this balance wrong. Hold too little, and you'll miss out on bargains. Hold too much, and inflation erodes your buying power. The right balance depends on your age, goals, and risk tolerance. Here's a quick breakdown of cash reserve recommendations by age group. Young investors, 20s to 30s, keep 5 to 10% of your portfolio in cash. This provides enough flexibility to capitalize on market dips without sacrificing long-term growth. With decades ahead, you can afford to be aggressive, letting compounding work in your favor. For example, consider a young investor who kept 7% of their portfolio in cash during the 2020 market crash. They used it to buy discounted tech stocks, which later doubled in value, significantly boosting their overall returns. Middle-aged investors, 40 to 55, aim for 10 to 15%. At this stage, you likely have more responsibilities and less time to recover from downturns. A larger cash cushion offers flexibility to seize opportunities without selling other investments at a loss. It also provides peace of mind for unexpected expenses. Retirees, 55 plus, allocate 15 to 25% to cash equivalents like treasury bills or money market funds. This protects your portfolio while keeping funds accessible for market opportunities. The exact percentage depends on your income needs and risk tolerance. Some retirees prefer higher cash allocations for security, while others stay more aggressive. Your cash reserve should also adapt to market conditions. When valuations are historically high, building extra cash makes sense. The Buffett indicator, which compares total market capitalization to GDP, can guide this. If the ratio exceeds 150%, consider increasing your cash position. When it drops below 100%, it's a signal to deploy cash into undervalued markets. The type of cash you hold matters too. Pure cash loses value to inflation, so consider laddered treasury bills or ultra-short bond ETFs. These options yield more than savings accounts while maintaining liquidity. During the 2020 crash, investors with treasury ladders accessed funds penalty-free to buy discounted assets. Keep your emergency fund separate from your investment cash reserve. Financial planners recommend 3 to 6 months of living expenses in an easily accessible account. This money is your safety net, not for investing. Only after funding this should you allocate additional cash for market opportunities. Mixing these purposes can lead to poor decisions during downturns. Rebalancing helps maintain your cash position. Set target percentages for each asset class, including cash. When one category grows beyond its target, trim it back. For example, if stocks surge and your cash allocation shrinks below target, sell some equities to rebuild your reserve. This disciplined approach ensures you're prepared for market dips. Market timing doesn't work, but cash management does. Don't try to predict crashes. Instead, maintain an appropriate cash reserve so you're ready when opportunities arise. During the 2008 financial crisis, investors with cash reserves bought quality assets at fire sale prices, while those fully invested had to sell at the worst time. Your cash position should reflect your risk tolerance. If market volatility keeps you up at night, holding more cash may be worth the opportunity cost. Conversely, if you can handle big swings, a smaller cash allocation lets you benefit more from market gains. There's no single right answer, only what works for you. Finally, consider keeping some cash in tax-advantaged accounts like IRAs or 401ks. This allows you to act quickly during market dislocations without triggering taxable events. Just remember, withdrawing cash from these accounts before age 59 and a half usually incurs penalties. Instead, focus on reallocating within these accounts when opportunities arise. Bottom fishing 101, spotting the real bargains. During market crashes, cheap stocks are everywhere. But here's the hard truth. Most are value traps that will never recover. In 2008, 42% of stocks that seemed like bargains went bankrupt within 2 years. Price drops don't automatically mean value. Some companies get hit hard for good reason. Think of value traps like counterfeit bargains. They look appealing but leave you worse off. To avoid them, use these 5 filters to separate temporary victims from permanent losers. First, check the balance sheet strength. Companies drowning in debt rarely survive economic storms. Look at the current ratio, current assets divided by current liabilities. Anything below 1 signals trouble, as the company can't cover its short-term bills. During the 2008 crisis, firms with current ratios under 0.5 had a 70% higher chance of bankruptcy. Strong companies maintain healthy balance sheets even in good times, so they can weather bad times. For example, Ford raised cash before the 2008 crisis, giving it the financial flexibility to survive, unlike General Motors, which was weighed down by massive debt. Next, examine cash flow stability. Earnings can be manipulated, but cash flow reveals the real story. Companies generating consistent operating cash flow through economic cycles make safer bets. During the COVID crash, businesses with strong pre-pandemic cash flows rebounded fastest. Avoid companies burning cash. They're the first to fail when credit tightens. For instance, Ford's ability to maintain better operations and cash flow helped it avoid GM's fate during the 2008 downturn. The third filter is industry resilience. Some sectors get crushed in every downturn, while others hold up better. Consumer staples, utilities, and healthcare tend to be more defensive because people still buy groceries, pay electric bills, and need medical care during recessions. In contrast, cyclical industries like travel, luxury goods, and construction suffer most. In 2008, airline stocks dropped 60%, while Walmart gained 20%. A steep price drop doesn't always mean opportunity. Some industries deserve their low valuations during tough times. Valuation metrics form the fourth filter. A low P/E ratio alone doesn't make a stock cheap. Compare current multiples to historical averages and industry peers. The price-to-book ratio matters too. Below 1 suggests the market values the company at less than its net assets. But beware of asset-heavy businesses where the assets might be overvalued. Enterprise value to EBITDA gives a clearer picture of cash flow valuation. During the 2020 crash, stocks trading at EV/EBITDA below their 5-year averages tended to recover the strongest. Finally, consider competitive advantage. Companies with durable moats survive downturns best. Look for strong brands, patents, or market positions that competitors can't easily replicate. In 2008, Coca-Cola's brand power helped it maintain pricing while weaker beverage companies struggled. Similarly, Wells Fargo's conservative loan practices and stronger balance sheet allowed it to weather the financial crisis, unlike riskier regional banks that went under. These 5 filters, balance sheet strength, cash flow stability, industry resilience, valuation metrics, and competitive advantage, help you avoid value traps. In March 2020, dozens of stocks looked cheap after the market crash, but many never recovered. The winners shared common traits: clean balance sheets, stable cash flows, defensive industries, reasonable valuations, and sustainable advantages. Returning to the example of General Motors versus Ford, the filters would have steered you away from GM despite its seemingly cheap price. GM's massive debt, negative cash flow, and weak competitive position made it a classic value trap. Ford, on the other hand, avoided GM's mistakes and emerged stronger. These filters are your toolkit for distinguishing counterfeit bargains from true opportunities. Sector secrets. Which industries bounce fastest? Not all sectors are created equal when markets crash. Some get crushed while others barely flinch. What most investors overlook is that the worst performers during a downturn often become the best performers in the recovery. This pattern has held true through every major market crash from 1929 to 2020. Consumer staples are the steady heartbeat of market crashes. They don't fall as hard, and they don't bounce as high, but they keep moving forward. People still buy toothpaste, toilet paper, and cereal even during recessions. During the 2008 crisis, Walmart gained 20%, while the broader market dropped 40%. These stocks won't make you rich overnight, but they'll help preserve your capital when everything else is tanking. Defensive sectors like utilities and healthcare also provide stability. Utilities are the ultimate safe haven. People keep paying their electric bills no matter what. These stocks barely dropped in 2008 and 2020, but they also don't bounce much. Healthcare splits into 2 categories: big pharma and medical device makers, which are stable, and biotech, which is more volatile but offers bigger upside. During the 2020 crash, Moderna went from $20 to $180 in 6 months. The key is understanding which healthcare companies have real products versus those relying on experimental treatments. On the other hand, cyclical sectors like travel, luxury goods, and energy take the hardest hits during downturns. Airlines dropped 60% in 2008, and cruise lines fell even harder in 2020. But these same sectors often lead the recovery. After hitting bottom, they can triple while more stable sectors are still crawling back. Timing is everything. You want to buy when the panic is at its peak, not before. Energy stocks, for example, follow the oil price roller coaster. When oil crashes, energy stocks get decimated, but they can snap back just as fast. After the 2020 oil price war, some energy stocks gained 300% in months. The volatility is extreme, but the opportunities are real. Technology stocks are a unique case. They tend to fall hard but recover faster than most sectors. During the dot-com crash, tech stocks lost 80% of their value, but survivors like Amazon and Apple came back stronger than ever. In 2020, tech led the charge out of the COVID crash. The Nasdaq recovered all its losses by June, while the Dow took until November. Financial stocks present a special challenge. Banks got crushed in 2008 for obvious reasons, but the strongest institutions like JP Morgan rebounded spectacularly. Wells Fargo stock went from $8 to $30 in just 2 years. The trick is identifying which banks have solid balance sheets versus those taking excessive risks. The ones that survive often deliver monster returns. Real estate shows how location matters. Commercial real estate got crushed in 2008 and again in 2020, while residential real estate fared better. REITs specializing in apartments and warehouses performed well during COVID, while mall and office REITs struggled. This sector requires careful analysis of property types and tenant quality. The worst mistake is chasing yesterday's winners. Investors who piled into tech in 2000 or banks in 2007 got crushed. The sectors that lead one recovery often lag the next. That's why you need fresh analysis for each crash rather than relying on past patterns. Sector ETFs can simplify this process. Instead of picking individual stocks, you can buy the entire sector. The U.S. Global Jets ETF, JETS, gained 100% in 6 months after the 2020 travel bottom. These funds let you bet on sector rebounds without stock-specific risk. Position sizing, the math behind crash profits. Finding the right stocks during a crash is only half the battle. The real difference between good returns and great ones comes down to position sizing, how much you allocate to each investment. Most investors get this wrong, either going too big and risking everything or staying too small and missing real opportunities. Controlling position size is crucial because it directly ties into risk management, ensuring you can stay in the game even when trades don't go your way. The 1% rule is a simple starting point. Never risk more than 1% of your total capital on any single trade. For example, if you have a $50,000 portfolio, cap your risk at $500 per position. This protects you from blowing up your account if a trade goes wrong. During the 2020 crash, traders who followed this rule could take multiple shots at the market without any single bet ruining them. Fixed fractional sizing builds on this by adjusting your position sizes as your account grows or shrinks. For instance, if you risk 2% per trade and your $50,000 account drops to $45,000, your new risk per trade becomes $900 instead of $1,000. This automatic adjustment prevents you from taking bigger risks when you're losing money, a common mistake that can spiral out of control. Volatility-based sizing is where experienced traders gain an edge. This method adjusts your position sizes based on how much each stock typically moves. A stock that swings 5% daily gets a smaller position than one that moves 2%. For example, if stock A has an average true range, ATR, of $3 and stock B has an ATR of $1, you'd allocate 3 times as much to stock B to maintain consistent risk. During the COVID crash, this approach allowed traders to stay in highly volatile stocks like airlines without getting wiped out by wild price swings. The Kelly criterion offers a more advanced approach for those who can estimate their edge. The formula is F equals BPQ/B, where F is the fraction of your capital to bet, B is the net odds, potential profit divided by potential loss. P is your probability of winning, and Q is your probability of losing 1p. For example, if you have a trade with 2:1 payoff potential and a 60% win rate, Kelly suggests betting 20% of your capital. However, most investors should use a fraction of the Kelly amount, maybe half or quarter Kelly, to protect against estimation errors. During the 2008 crisis, traders using fractional Kelly sizing could participate in the recovery without overexposing themselves to any single opportunity. Laddering your entries is another smart move during volatile markets. Instead of putting all your money in at once, divide your position into smaller chunks. By the first part when you identify the opportunity, then add more if the price moves against you. This lowers your average entry price while capping your risk on each individual purchase. Stop losses work hand in hand with position sizing. Your stop determines how much you're willing to lose on a trade, while your position size determines how much that loss will cost you in dollars. For example, if you set a 10% stop on a stock at $50, you're risking $5 per share. To keep your total risk at 1% of a $50,000 account, $500, you'd buy 100 shares, $5,000 position. The math keeps everything aligned. Finally, portfolio heat measures your total exposure across all positions. Even with small individual positions, you can get overexposed if all your trades move together. Smart traders limit their exposure to any single sector to 10 to 15% of their portfolio, no matter how many individual positions they have. The 2008 case study, Opportunities Most Missed. Hindsight makes the 2008 financial crisis look like a giant neon sign flashing by now. But at the time, most investors were too scared to act. Let's break down 3 opportunities nearly everyone missed, and how disciplined investing turned them into massive wins. First up, bank stocks. When Lehman Brothers collapsed in September 2008, investors fled financial institutions en masse. But not all banks were equally vulnerable. Wells Fargo, for example, traded below $8 per share in March 2009, about 1/6 of its pre-crisis high. Unlike many competitors, Wells Fargo maintained stronger underwriting standards and avoided the riskiest mortgage-backed securities. Investors who recognized this could have bought the stock at fire sale prices. By 2011, it had climbed to $30 and continued rising. Meanwhile, weaker banks either failed or were acquired for pennies. The takeaway? When an entire sector is punished, focus on the strongest players unfairly dragged down. Goldman Sachs offers another striking example. In the depths of the crisis, Warren Buffett invested $5 billion in Goldman preferred shares yielding 10% annually, along with warrants to buy common stock at $115 per share. At the time, this seemed risky. Goldman's survival wasn't guaranteed. But Buffett saw the firm's elite position in investment banking as a durable advantage. By 2011, Goldman shares traded above $150, making the warrants highly valuable. The preferred shares alone paid $500 million annually in dividends. While regular investors couldn't replicate Buffett's deal, they could have bought Goldman common stock at depressed prices. From $47 in November 2008, the stock surged to over $170 within 3 years. The lesson: crisis conditions often create opportunities to invest in strong companies on favorable terms. Distressed real estate was another area of opportunity. While most investors focused on stocks, Carl Icahn purchased the bankrupt Fontainebleau Las Vegas property for $155 million, just 4% of its construction cost. This wasn't a gamble, it was a calculated move. Icahn understood the property's prime location on the Vegas Strip would retain value long-term. He held it until 2017, selling for nearly $600 million. Similar opportunities existed across commercial real estate, where desperate sellers offered steep discounts. Residential real estate also presented bargains. In hard-hit markets like Phoenix and Miami, home prices dropped over 50%. Savvy buyers who purchased rental properties locked in high yields and significant appreciation as markets recovered. The key: focus on assets with intrinsic value that can outlast temporary crises. What made these opportunities so impactful? First, they involved fundamentally strong assets temporarily depressed by panic. Wells Fargo and Goldman Sachs were better run than competitors, and the Fontainebleau's location was irreplaceable. Second, each offered asymmetric risk-reward, limited downside with significant upside. Buffett's Goldman deal guaranteed 10% annual returns even if the stock didn't rise. Third, they required acting against the crowd when fear was at its peak. In March 2009, media outlets amplified doomsday scenarios, making risks seem larger than they were. Most investors missed these chances due to psychological barriers. Fear, herd mentality, and loss aversion kept them on the sidelines. Those who profited focused on fundamentals, had cash ready, and accepted short-term losses for long-term gains. The patterns repeated in 2020 during COVID, when sectors like banking and travel were crushed but rebounded sharply. The next crisis will bring similar opportunities, if you know how to spot them. The biggest lesson? Crises don't change what makes a good investment. They just make good investments cheaper. Wells Fargo was a strong bank before, during, and after 2008. Goldman Sachs remained a premier investment bank. The Fontainebleau's location didn't move. What changed was the price investors could pay. Those who succeeded didn't have special information. They had the discipline to act when others froze. COVID crash secrets. What worked in 2020? March 2020 wasn't your typical market crash. Picture this. Bustling cities fell silent, businesses shuttered overnight, and uncertainty gripped the world as a virus brought the global economy to its knees. The S&P 500 plummeted 34% in just 33 days, marking the fastest bear market in history. While most investors panicked, a select few saw opportunity in the chaos and adapted with bold strategies. Traditional crash strategies failed spectacularly in this environment. Buying the dip too early led to painful losses as markets kept spiraling downward. Value stocks, typically a safe bet, continued to sink while growth names rebounded first. Even gold, the classic safe haven, initially dropped as investors scrambled to liquidate everything for cash. The winners in this crisis were those who recognized the need for new tactics. One of the most effective strategies was identifying companies that thrived under lockdown conditions. While airlines and restaurants faced devastation, Zoom skyrocketed from $70 to $350 in just 6 months as remote work became the norm. Peloton surged as gyms closed, and Amazon added $570 billion in market value as online shopping exploded. These weren't speculative gambles. They were clear beneficiaries of a seismic shift in consumer behavior. Investors who spotted these trends early reaped massive rewards. Another key approach was sector rotation. Tech and healthcare led the recovery, while energy and financials lagged behind. The Nasdaq regained all its losses by June 2020, months ahead of the Dow. Traders who pivoted into growth sectors early captured the biggest rebounds. For example, the ARK Innovation ETF soared 150% in 9 months by focusing on disruptive tech companies. Options trading also became a powerful tool during the extreme volatility. The VIX Fear Index hit an all-time high of 82, creating opportunities for traders to profit from the wild swings. In February, those who bought puts saw huge gains as markets crashed. By March and April, call buyers capitalized on the rebound. One trader famously turned $30,000 into $2.8 million trading SPY options during this period. While risky, options offered a way to amplify returns in a turbulent market. Retail investors also found new ways to participate. Commission-free trading apps like Robinhood made the market more accessible, and online communities like Reddit's Wall Street Bets coordinated dramatic moves in beaten-down stocks. GameStop became the poster child of this phenomenon, surging from $4 to $483 as retail traders took on hedge funds. Though speculative, this highlighted how new dynamics were reshaping the market. Government intervention added another layer of opportunity. The Federal Reserve slashed interest rates to zero and injected trillions into the economy. Savvy investors tracked which sectors would benefit most. Homebuilders like Lennar soared as mortgage rates dropped, while bank stocks eventually rebounded as yield curves steepened. Even junk bonds rallied as the Fed backstopped corporate debt markets. The work-from-home revolution also created lasting winners. Companies enabling remote work saw explosive growth. Cloudflare tripled as demand for better online infrastructure surged. DocuSign doubled as paperwork went digital, and Shopify became Canada's most valuable company as small businesses moved online. These trends were clear by April 2020, but many underestimated their staying power. The key takeaway from 2020? Crises don't just test old strategies, they create entirely new opportunities. While traditional value investing eventually recovered, the biggest gains came from those who adapted quickly to the pandemic's unique challenges. The Buffett indicator: when to go all in. Most investors struggle with one simple question during market crashes: when is it cheap enough to buy? The Buffett indicator acts like a thermometer for market health, using cold, hard math to provide an answer. This single metric, total stock market value divided by GDP, has identified every major market bottom since 1950. It shows when markets are truly undervalued versus just less overpriced. During the COVID crash, the indicator dropped to 130%, still high by historical standards. That's why many bargain hunters got burned buying too early. Compare that to 2009, when it hit 75%, signaling one of the best buying opportunities in decades. Even during crashes, markets can remain expensive relative to the real economy. This metric helps you avoid that trap. Warren Buffett popularized this ratio because it measures whether stock prices align with economic output. When the ratio is too high, stocks are disconnected from reality. When it drops too low, you get fire sale prices. Historically, the sweet spot for going all in has been when the indicator falls below 80%. Let's break this down with an example. In March 2009, the indicator hit 75% as GDP shrank and stock prices collapsed. Investors who bought then caught the start of an 11-year bull market. Contrast that with March 2020, when the indicator only dropped to 130%. Stocks rebounded quickly because they weren't that cheap to begin with. The indicator helps separate real bargains from temporary discounts. The math is simple but powerful. Add up the market cap of all publicly traded stocks and divide by GDP. The result shows whether stocks are priced appropriately for the economy's size. Above 100% means expensive. Below 80% means historically cheap. The further below 80%, the bigger the buying opportunity. This metric works because it's grounded in economic reality. Stock prices can detach from fundamentals during bubbles or panics, but they always reconnect with the economy eventually. The Buffett indicator spots these disconnects, showing when markets are truly cheap versus just less frothy. Take the dot-com bubble. In 2000, the indicator hit 145%, a clear warning sign. Even after the crash, it stayed elevated at 100% in 2002. Many investors thought stocks were cheap then, but the indicator showed they were just fairly valued. True bargains came later, when it dipped below 80%. The indicator's track record is unmatched. It predicted the 1974 market bottom at 75%, the 1982 bottom at 60%, and the 2009 bottom at 75%. Each time, buying when the indicator dipped below 80% led to massive gains as markets normalized. Here's how to use it in your investing. First, track the current ratio. We'll link resources below. When markets crash, don't just look at price drops. Check if the indicator has reached bargain levels. Below 80% means it's time to get serious. Below 70%, back up the truck. Above 100%, stay cautious, even during dips. The indicator works globally too. Apply it to any country's stock market by using their market cap and GDP. In 2020, some international markets became truly cheap while U.S. stocks remained relatively expensive, helping investors find better opportunities abroad. One warning: the indicator isn't perfect for timing exact bottoms. In 2009, it hit 75% in March, but markets wobbled for months. The key is recognizing bargain territory, not catching the absolute low. Patient investors who bought throughout 2009 still made fortunes. The biggest mistake: ignoring the indicator and buying too early. In 2008, many jumped in when stocks were down 20%, only to watch them fall another 40%. The indicator would have shown markets were still expensive. Discipline matters more than excitement during crashes. Crash-proofing your portfolio before disaster strikes. The smartest investors don't scramble when markets crash. They've already done the work. While everyone else panics, they're calmly executing plans made during sunny days. Most portfolios aren't built for storms until it's too late. But you can fix that right now with 4 simple adjustments that'll put you ahead when the next downturn hits. Picture this: an investor who, during the 2020 crash, watched their balanced portfolio hold steady while others around them scrambled. They had bonds that gained value, cash to buy the dip, and defensive stocks that softened the blow. That sense of relief. It's what proper preparation feels like. First, diversification. This doesn't just mean owning a mix of tech stocks. True diversification spreads your money across assets that don't move together. Stocks and bonds are the classic pair. When stocks tank, bonds often rise as investors flee to safety. During the 2008 crash, long-term treasury bonds gained 30%, while stocks dropped 50%. That cushion can make all the difference. Beyond that, consider adding real estate through REITs, commodities like gold, and even a small allocation to crypto for newer portfolios. The goal isn't to eliminate risk, but to ensure your portfolio doesn't sink all at once. Next, bond allocation. Not all bonds are created equal in a crisis. Long-term treasuries are the gold standard for crash protection. Corporate bonds, while offering higher yields, tend to drop alongside stocks during market panics. In March 2020, long-term treasuries jumped 8% in a month, while corporate bonds fell. The takeaway? Keep a portion of your bond portfolio in government securities. They're the ultimate shock absorber when everything else is falling apart. Cash is your secret weapon, but it's often misunderstood. You don't want all your money sitting idle, but having 5 to 10% of your portfolio in cash or cash equivalents like money market funds gives you flexibility. During the COVID crash, investors with cash could scoop up quality stocks at bargain prices. Those fully invested had to either sell at a loss or miss the opportunity entirely. Cash isn't about giving up growth. It's about being ready when opportunity knocks. Finally, defensive stocks. These are companies that sell essentials people need no matter what: utilities, healthcare, and consumer staples. During the 2008 crisis, Walmart gained 20%, while the broader market dropped 40%. Defensive stocks won't make you rich overnight, but they'll preserve your capital when everything else is tanking. Look for companies with strong balance sheets, consistent cash flow, and products that stay in demand during recessions. They're the anchors that keep your portfolio steady in stormy seas. Here's the key: these adjustments work together. Diversification smooths out the bumps. Bonds provide stability. Cash gives you options. Defensive stocks limit your downside. Combined, they create a portfolio that can weather almost any storm. The best part? These moves don't hurt your returns in good times. A 60-40 stock bond portfolio has historically returned about 8 to 9% annually with much less volatility than all stocks. You give up a little upside to avoid catastrophic losses, a trade-off that pays off over time. Rebalancing is how you maintain this balance. Set target percentages for each asset class. Say 50% stocks, 30% bonds, 10% real estate, 10% cash. When one category grows beyond its target, trim it back. This forces you to sell high and buy low automatically. If stocks surge and your cash position shrinks, selling some stocks to rebuild your cash reserve makes sense. It's the opposite of what most investors do. They chase what's going up and sell what's going down. Your exact mix depends on your age and risk tolerance. A 30-year-old might go 70% stocks, 20% bonds, 5% real estate, 5% cash. A 60-year-old might flip that to 40% stocks, 50% bonds, 5% real estate, 5% cash. The specifics matter less than having a plan and sticking to it. What kills portfolios isn't market crashes. It's investors who panic and abandon their strategy at the worst possible time. The insider's edge, tools the pros use. You don't need a Bloomberg terminal to get professional-grade market insights. There are free tools that give you the same data the pros use to spot crash opportunities. Let me show you how to level the playing field without spending a dime. Finviz is a powerful stock screener that filters stocks using key ratios like P/E and dividend yield. For example, you can quickly find companies with P/E ratios under 10 and dividend yields over 5%. During the 2020 crash, savvy investors used it to uncover undervalued stocks before the rebound. The free version is robust enough for most investors. TradingView offers advanced charting tools for technical analysis. Use it to draw trend lines, plot Fibonacci retracements, and set alerts, all for free. When markets get volatile, these tools help you identify support levels where stocks might bounce. Even hedge fund analysts use TradingView alongside premium platforms. Yahoo Finance is a go-to for fundamental data. It tracks essential ratios like PE, PB, and debt to equity, and its financial statements section provides cash flow, balance sheets, and income statements. During the COVID crash, Investors relied on it to find companies with strong balance sheets that could weather the storm. The Federal Reserve Economic Data, FRED, website is a hidden gem for macroeconomic insights. It tracks indicators like treasury yields and money supply growth, helping you gauge whether markets are truly cheap during crashes. For example, when the Buffett indicator drops below 80%, FRED can confirm it's time to buy. Seeking Alpha provides free articles with institutional quality analysis. Writers break down earnings reports and industry trends in plain English, and the comment sections often add valuable perspectives. This resource helps you separate real bargains from value traps during market turmoil. Google Sheets has a handy Google Finance function. For instance, typing equals Google Finance, AAPL, P, pulls Apple's PE ratio directly into a spreadsheet. You can build your own valuation models and track key metrics across your watch list without paying for expensive software. The SEC's Edgar database gives you direct access to company filings like 10KS and 10QS. These filings reveal critical details, such as which companies have strong cash positions to survive uncertain times. It's a must-use tool for serious investors. The St. Louis Fed's Financial Stress Index quantifies market stress levels using 18 indicators. When the index spikes, it often signals peak panic selling. This helped investors time their entries during past crashes. Portfolio Visualizer is a free tool for backtesting strategies. You can see how different asset allocations performed during crises like 2008 or 2020. It's an excellent way to stress test your portfolio before the next downturn. YCharts offers free valuation ratios and historical charts. These tools help identify when sectors are oversold. For example, during the COVID crash, investors used YCharts to spot when travel stocks had fallen too far too fast. The CBOE Volatility Index, VIX, is available on most broker platforms. When the VIX spikes above 40, it often signals maximum fear and potential buying opportunities. In March 2020, it hit 82, marking one of the best entry points in decades. The Treasury Department's website provides bond market insights, including yield curve data. An inverted yield curve often precedes recessions, while a steepening curve can signal recovery. This data helped investors navigate the 2008 financial crisis. Stock Analysis offers a simple valuation tool that compares a stock's current multiples to its historical averages and industry peers. This helps you identify overreactions versus justified drops during market crashes. The AII Investor Sentiment Survey tracks retail investor moods. When bullish sentiment drops below 25%, it often marks market bottoms. This contrarian indicator has helped investors buy when others were panicking. Your brokerage account likely has free research tools you're not using. Platforms like Fidelity, Schwab, and E-Trade offer institutional-grade reports to clients. These tools helped individual investors make informed decisions during the 2020 crash. By combining these tools, you can get a complete picture. Check valuation ratios on Yahoo Finance, analyze charts on TradingView, and verify financials through Edgar. This multi-source approach mirrors how professionals work, giving you the confidence to navigate market volatility like a pro. Tax tricks, turning losses into advantages. Market crashes create more than just investment opportunities. They open doors for tax advantages too. While many investors focus solely on gains, savvy ones use these strategies to turn losses into tax benefits. With the right approach, you can even get the IRS to help fund your investments during downturns. Tax loss harvesting is one of the most effective tools in your arsenal. Here's how it works. When an investment drops in value, you sell it to realize the loss. That loss offsets capital gains from other investments. For example, if you have $10,000 in gains from stocks sold earlier in the year and sell another position at a $10,000 loss, the two cancel each other out, leaving you with no taxes owed on that profit. You can then reinvest the money into similar, but not identical, assets, keeping your portfolio ready for recovery while locking in tax savings. However, the wash sale rule is key to remember. It prevents you from buying the same or substantially identical security within 30 days before or after the sale. But you can still buy similar assets, like selling one tech ETF and purchasing another with a different composition. During the 2020 market crash, investors who harvested losses not only offset earlier gains, but also carried forward excess losses to future years, creating a long-term tax shield. Roth IRA conversions are another powerful strategy during downturns. When asset values drop, converting from a traditional IRA to a Roth means paying taxes on a lower account value. For instance, if your $100,000 IRA falls to $60,000 in a crash, converting at the lower value means you pay taxes on $60,000 instead of $100,000. Once markets recover, all future growth in the Roth is tax-free. Investors who timed these conversions during the COVID crash saved thousands in future taxes while setting themselves up for tax-free growth. Another approach combines harvesting losses in taxable accounts with making new contributions to retirement accounts. In your taxable account, you sell underperforming assets to harvest losses. Then, you use some of that money to fund new IRA or 401k contributions, buying assets at depressed prices. This strategy offsets gains elsewhere while positioning your portfolio for recovery, essentially giving you a discount on your investments. Unused losses can also be carried forward. If your capital losses exceed your gains in a given year, you can deduct up to $3,000 against ordinary income, with any remaining losses carrying forward indefinitely. Investors who harvested significant losses in 2008 used them to offset gains for years, creating a lasting tax advantage. Tax gain harvesting flips the script during recovery periods. As markets rebound, you can selectively realize gains up to the top of your current tax bracket, resetting your cost basis higher while paying taxes at potentially lower rates. This is especially useful for investors in lower tax brackets, as it minimizes future taxable gains if rates increase. Rebalancing within retirement accounts is another tax-smart move. Instead of selling assets in taxable accounts and triggering gains, you can adjust your portfolio within an IRA or 401k without creating taxable events. During the 2020 crash, investors who rebalanced in retirement accounts avoided capital gains taxes while aligning their portfolios with market conditions. Qualified opportunity funds offer another option for deferring capital gains. By reinvesting gains into these funds within 180 days, you defer taxes on the original gain until 2026. If held for 10 years, any appreciation on the investment becomes tax-free. While complex, this strategy can be valuable for those with large gains looking to redeploy during market dislocations. Finally, consider state tax implications. States like Florida and Texas have no income tax, while others like California impose high rates. Timing moves like Roth conversions for when you're in a lower tax state can save thousands, especially on large transactions. The key to all these strategies is preparation. Track your gains and losses, understand your cost basis, and know which assets are in which accounts. Tools like cost basis tracking in brokerage accounts can help. The investors who benefit most are those who plan ahead, positioning themselves to take full advantage of these opportunities. The emotional checklist: staying disciplined when blood is in the streets. Your hands will shake when it's time to buy during a market crash. Your heart will race. Studies show cortisol levels spike 37% during market drops, triggering the same fight or flight response as physical danger. This biological reaction happens precisely when the best investment opportunities appear. The investors who make money aren't the ones without fear. They're the ones with a system to override it. Picture this: March 2020. Markets are in freefall. Sarah, a small-time investor, watches her portfolio lose 30% in days. Her instinct screams to sell everything, but she pauses. She pulls out her checklist, takes a deep breath, and follows the steps. By the time the market rebounds, Sarah has not only avoided losses but doubled her gains. This system works because it keeps you grounded when emotions run high. Behavioral finance explains why this is so critical. Your brain isn't wired for rational investing during crises. Fear and greed take over, pushing you to sell low and buy high. Herd mentality makes you follow the crowd straight off a cliff. Loss aversion tricks you into holding losers too long and selling winners too early. These aren't character flaws, they're human nature. But nature can be beaten with preparation. Here's your emotional checklist for the next market crash. Print it. Save it. Stick it on your wall. These steps will keep you focused when blood is in the streets and your instincts scream to run. Rule 1. Pause before clicking. When markets drop 5% in a day, your first urge will be to act. Don't. Set a 24-hour rule. No selling decisions until you've slept on it. During the 2020 crash, investors who waited just one day often avoided panic selling at the lows. Markets move in cycles, not straight lines. Measure twice. Cut once applies to selling two. Before dumping any position, Answer these 3 questions. Has the company's long-term outlook changed? Are operating cash flows still positive? Is the balance sheet strong enough to survive? If the answers are no, no, and yes, hold tight. Price drops without fundamental deterioration are opportunities, not threats. Implement the 1% rule for risk management. Never risk more than 1% of your total portfolio on any single trade. This automatic circuit breaker prevents any one decision from ruining you. If you have a $100,000 portfolio, that means limiting losses to $1,000 per position. Knowing you're protected takes the edge off extreme volatility. Rebalance on schedule, not emotion. Set predefined dates to adjust your portfolio. Quarterly works well. Stick to them regardless of market conditions. This forces you to sell high and buy low systematically. Emotional traders do the opposite. They chase performance and flee declines. Your calendar is your co-pilot through turbulence. Keep a trading journal. Write down every decision and why you made it. Note your emotional state at the time. During the 2008 crisis, traders who journaled avoided repeating mistakes because they could review their thought process. Patterns emerge. Maybe you always sell too early when worried about work stress. Spotting these tells helps you separate logic from emotion next time. Set price alerts, not market watches. Obsessively checking tickers feeds anxiety. Instead, program alerts at key levels you've predetermined. If Apple hits your buy target, you'll know. Otherwise, turn off the noise. In March 2020, investors who stopped watching CNBC made better decisions than those glued to the fear-mongering. Finally, remember your worst trade. We all have that one terrible decision that haunts us. Maybe you sold Amazon in 2001 or bought Bitcoin at the 2017 top. Keep a reminder of it visible. When the next crisis hits, ask, am I about to repeat that mistake? Sometimes fear of repeating history is the best teacher. My personal crash playbook, step by step. When the next market crash hits, here's exactly what I'll do. No secrets held back. This playbook comes from studying every major crash from 1929 to 2020. Most investors fail because they lack a written plan, making emotional decisions that cost them money. You can use this as your template or adapt it to your own strategy. First, I'll check the Buffett indicator. If total market cap to GDP drops below 80%, it signals bargain territory. During the 2008 crisis, it hit 75%. Below 70% means it's time to act decisively. This metric has reliably predicted major market bottoms since 1950. Next, I deploy cash strategically. I always keep 10% of my portfolio in cash equivalents like treasury bills. This becomes my ammunition during crashes. I divide it into 3 portions. The first third gets invested when the Buffett indicator hits my target, the second third after a further 10% drop, and the final third if another 10% decline occurs. Think of it as stepping down a staircase, ensuring I don't go all in too early. For stock selection, I apply 5 filters. First, balance sheet strength, current ratio above 1 and manageable debt. Second, cash flow stability, positive operating cash flow through cycles. Third, industry resilience, favoring consumer staples and healthcare. Fourth, valuation, PE and PEG below historical averages. Fifth, competitive advantage, brands or patents that endure. These criteria ensure I'm buying quality companies at attractive prices. I focus on dividend payers with sustainable yields. During the 2008 crisis, companies maintaining dividends recovered faster. I target yields between 3-6%, high enough to reward patience, but not so high that cuts are likely. Dividends act as a margin of safety while markets recover. Position sizing is critical. No single stock exceeds 5% of my portfolio. I size positions based on volatility. Stocks with larger price swings get smaller allocations. For example, in a $100,000 portfolio, a stock with 5% daily moves might get 2%, while one with 2% moves could get 5%. This keeps risk balanced. I set price alerts instead of watching markets constantly. Obsessing over tickers leads to bad decisions. Alerts notify me when key levels are hit, so I can act deliberately. In March 2020, investors who avoided constant monitoring made better choices than those glued to CNBC. Tax loss harvesting happens automatically. Any position down 20% or more gets reviewed. If fundamentals remain strong, I'll sell to capture the loss and immediately buy a similar replacement. This locks in tax benefits while maintaining market exposure. Rebalancing occurs quarterly, regardless of market conditions. If stocks drop below target allocation, I'll use cash to buy more. If they surge above target, I'll trim winners. This forces me to sell high and buy low systematically. I monitor the worst performing sectors closely. In 2008, financials were crushed, but the strongest banks rebounded dramatically. I look for sectors down 40% or more, then identify the healthiest companies within them. Options play a supporting role. I buy puts on stocks I own as insurance and sell cash-secured puts on stocks I want to own at lower prices. This generates income while setting buy points below market. Finally, I journal every decision during market stress. Each trade is recorded with my reasoning and emotional state. This creates accountability and helps me identify patterns, like selling too early when stressed. Crashes are normal. The key is having a plan so you can act when others panic. When to sell, locking in crash profits. Knowing when to sell is just as important as knowing when to buy during a market crash. Even the best crash purchases can turn into losers if you hold them too long. Many investors make the mistake of getting greedy during recoveries, watching their paper profits disappear because they didn't have an exit strategy. Here's how to lock in your gains without leaving money on the table. To simplify, here are the key sell signals to watch for. Valuations returning to historical norms. That stock you bought at a PE ratio of 8 during the crash? When it hits its 10-year average PE, it's time to reevaluate. In 2009, investors who bought bank stocks at fire sale prices saw many triple within 2 years. The smart ones sold when valuations normalized, while others held too long and gave back gains. Check metrics like PE, PB, and dividend yield against their long-term averages. When they reach typical levels, consider taking profits. Market sentiment and technical indicators. When headlines shift from doom and gloom to irrational exuberance, pay attention. In early 2020, fear dominated in March, but by August, everyone seemed to be a stock market genius. This shift from fear to greed often signals the end of easy money. Tools like the CNN Fear and Greed Index can help. Combine this with technical analysis. If a stock that's been rallying falls below its 200-day moving average on heavy volume, it may indicate a trend reversal. These signals together can help you time your exits more effectively. Position sizing. If a crash purchase grows to more than 10% of your portfolio, trim it back. For example, if you bought $5,000 of a stock during the crash, and it grows to $15,000 while the rest of your portfolio stays flat, selling $5,000 brings your position back to a manageable size while locking in gains. This method takes the emotion out of selling. Dividend cuts. Companies that can't maintain payouts during recoveries often have deeper problems. During the 2008 financial crisis, banks that cut dividends typically underperformed for years. If a company you own cuts its dividend, it's a clear signal to move on. Insider selling. Watch for spikes in insider selling. If multiple executives at a company you own are dumping shares during the recovery, it's worth investigating further. While not always a reason to panic sell, it can be a red flag. Sector rotation. The sectors that lead during recoveries often lag afterward. Financials led after 2008 but underperformed later, while tech led in 2020 before giving back some gains. When leadership shifts from your crash purchases to other sectors, consider reallocating. Tax considerations. If you're sitting on big gains, think about holding at least a year for long-term capital gains rates. But don't let taxes dictate your decisions. If your thesis has changed or fundamentals have deteriorated, it's better to pay the taxes than watch gains disappear. Original investment thesis. Always return to your original thesis. If the reasons you bought the stock no longer hold, it's time to sell. Stocks don't care what you paid for them. They only care about future prospects. One investor in 2009 used a laddered sell strategy to avoid greed. They sold 1/3 of their position when valuations hit historical averages, another third when they reached 1 standard deviation above, and the final third at 2 standard deviations. This approach locked in gains while leaving room for further upside, a disciplined strategy that paid off. Finally, don't forget to rebalance regularly. If your crash purchases have grown to dominate your portfolio, rebalancing forces you to sell high and buy low. Set calendar reminders to rebalance quarterly or annually. This systematic approach removes emotion from selling decisions and keeps your portfolio balanced. Market crashes don't destroy wealth. They transfer it to those who are ready. When stocks plunge, most see disaster. You'll see opportunity. Crashes are when fortunes are made. The next time markets tumble, you won't freeze, you'll act. With tools like the Buffett indicator, sector rotation strategies, and a calm mindset, you'll be prepared. Start today. Build your cash reserve, study valuation metrics, and practice staying steady under pressure. Picture this. While others